both of you are very experienced investors who have experienced market cycles in the past. So let's begin with the macro as a background for our discussion. How do you see it? Are we facing the dot-com bubble, or is this something else?
I think every downturn is different. I think you have to step back and obviously look at the factors. I tend to think that we're in a moment now where pessimists sound really smart, but optimists are going to make a lot of money. So why am I optimistic? I think that if you look at venture over the last 30 years, it works best when capital is expensive and time is cheap. And I don't think we're at the point right now where time is cheap, but it's cheaper. First round capital, a great early stage firm in the Bay Area, tracked how long between seeing a deal and closing during the course of their tenure. And in 2005, that averaged 100 days. In 2014, that compressed to 50 days. In 2019, it was 50 hours. It's hard really to imagine, right, that's an attractive environment. So we're encouraged when our GPs tell us we now have a little bit of time to digest and think more thoughtfully about opportunities. So I think that's a factor. And the other factor I think is positive is that Darwinism is now at play again. And I think a lot of funds out there who misbehaved, and frankly, portfolio companies that should never have been funded are going to be revealed. And I think that's going to make an asset allocator's life a little easier.
So I've invested through the dot-com bubble, 2008 Great Recession, and one that you didn't mention, which was like the first 2 months of COVID, which we tend to forget because of the Super Bowl bounce back that we all had.
And the COVID.
Yeah. This is not that. This is not a bounce back like 2020 for sure. But I also don't think this is the dot-com bubble. And when I remember back in that era, the unprofitable growth companies, well, that was the whole market, right? Where when it burst and all the air came out, everyone realized that there was not really anything there. Today, we've got a lot of these unprofitable growth companies, but the big difference is most of them, many of them, they're real businesses. And if they're unprofitable, it's by choice in many cases. So they can, cut their growth rate, reduce spending on marketing, and get to break even. And that's what everyone's been doing all year. And so I feel very strongly, this is not the dot-com crash. And it's mainly because of the companies. These are real businesses, real companies. And I think it's really important for every company today to be in a position where they can pivot if they need to become break even and get that infinite runway if they need it.
Yeah. As we see it at Vintage, 2021 was time to take money off the table and invest very carefully. And markets have now changed, so it seems that we are in the beginning of a good time to investing. In other words, buy low and sell high. Earlier we heard several VCs, and you as LPs, I'm curious to know, how do you plan to play it?
So I would say, it's kind of interesting as I was thinking about this conversation. As an LP, I think what we're going to do is go slow, but also go fast. And here's what I mean by that. So it's kind of a flight to quality. I like to try and understand these kinds of questions by analogy. So I think of the whole market as we're in a giant baseball game, okay? And for the last 3 years or more, we've been getting these 90-mile-an-hour fastballs, and everybody's hitting it out of the park. It's, no problem. Suddenly, there's a new pitcher that's come in, right? And we're seeing curveballs, we're seeing sliders, and a lot of these hitters, they've never seen curveballs before. And so, normally you would say as an LP, well, if you've done it before, we like you, we think you can do it again. But there is a whole generation of firms that have never seen this kind of market. And we don't know if they know how to hit a curveball or not. Now, in baseball, it usually takes a few innings before you adjust to the new pitcher. Now, you've got your top tier players, your top performers. Yeah, we're going to grab them as quickly as we can because we know they've done it before. We know they can perform in this market, but it's a much smaller group. And so we're inclined to go fast on those top performers, make sure we get our spots. But on the rest of the market, it's a much more cautious approach.
I like that answer. I think, we use the short term in the office, is it luck or skill? And discerning the difference when you're evaluating a GP is hard. And I think that baseball analogy works. I think that we're going to continue to deploy because you can't time these markets. Hopefully, we'll have confidence that the GPs will stretch out their deployment pacing a little bit more over 36 months, and anything can happen in 36 months. But I do take comfort in the same idea that, as I've referred to Darwinism, we now have the opportunity to see how GPs are behaving. We can talk to the portfolio companies. We can see how they're managing through this with the advice and guidance of the GP. And that's really important for trying to identify the truly elite deployers of capital.
Okay, so it relates to my next question. How do you decide in which GP to invest? What are the questions that you like to ask GPs before considering investing in them? You told me that you have specific questions you love to ask.
Well, I like to surprise the GPs with those questions. Now I've blown it all.
Spoilers.
Okay, giving away my secrets. Well, the threshold for us, I'm sure it's the same with Rick, we only want to deal with good people. Right? High integrity is a given. If we are not 100% confident in that, we move on. So assuming we've established that, we're looking for authenticity. And authenticity is the second question we ask. Are the GPs self-aware? Do they have a sense of a little bit of fear? Or is it pure hubris? And one of the questions I ask, which I'm now is going to fall out of my repertoire, I like to ask the GP if they're raising, say, Fund 3, it's $300 million target. I say, assume the following. Assume you're going to raise this target $300 million. Assume you're going to deploy it in the fashion you've just articulated in your pitch. Assume further there's no widespread economic calamity. Right? A non-zero probability in fact, but for purposes of my hypothetical, a zero probability. Now assume further we sit down in 10 years and look back at your Fund 3 and assume we're all disappointed. What will have been the most likely cause? And it's shocking to me how many times, surprisingly perhaps, some GPs refuse to accept the premise of the question and say, well, we've never failed. And that usually, clicks the hubris box. But we like to hear what the GPs say in response to that, because that demonstrates authenticity, self-awareness, and when they can say, listen, here are the two things we could really screw up. If we did, we don't think we are, but it would probably look like this. And then the next question, of course, is how are you mitigating? And then if they have a plan for that, then it becomes a self-denying prophecy. So in an environment where everything is up and to the right and track records look great, that's the type of question I think that reveals, how thoughtful the GPs are.
So it's actually really hard to evaluate GPs in this market because everyone has great numbers now, right? And so one of the things that I would say is, so how have you changed your strategy from the last 5 years for your new fund? What are you going to do differently? Now, it depends. Some people will say they're doing the same thing, and that might be okay, depending on their specific strategy. But most of them should be doing something differently because the world has changed so much. And, one of the things that we do is because we also like to do direct deals, including leading direct deals, we will very often want to do a direct investment alongside a GP before we consider going into their fund and serve on a board together and do all of that. And it's venture capital is risky and it doesn't always work. And if you make a mistake or it doesn't go well in a company, it's too bad, but you turn the page, you walk away to the next one. You make a mistake in a fund, it is so much worse. You have to keep writing checks for 10 years. And so, you really have to avoid those mistakes. Yes. And one of the best ways I find is to kind of, see them in action at the board table? Do they show up? Do they do what they said they were going to do? If we meet somebody for the first time while they're pitching us on their fund, almost no chance we will invest in that fund. Now, we might like to meet them and get to know them, and maybe it's the next one, but it's really important to spend that time.
Looking back at your best or worst investments, could you share with us one or two lessons learned, for example, what to do or what to avoid?
Well, I kind of think that because of our strategy of an unfair advantage by having these relationships, not just with the GPs in our portfolio, but all of the GPs who want us to be be one of their LPs in the future, right? So, we love to kind of cherry pick investments out of fund portfolios. We will invest in seed funds with the view of getting access to their great follow-ons in the future. And, I'd say the best investments we've made have been where we've done an early venture investment, gotten to know a company, small check, but you kind of get close to it. And then opportunistically, something happens a few years later where, you can grab a big chunk, maybe in a secondary or something, but you've got to move like in a week. But we can do that because we know the company already, and it just becomes a price discussion. And so that...
It's like a toe in the water?
Yeah, exactly. And, also we like to tell people pitching us, well, show us some of your deals. And, if it goes well, we like what we see. It doesn't always mean that you got to have the best returner because there's a lot of luck. But you can tell the difference between whether it was a good company or a bad one.
I don't know if I'm prepared to give specific names, but I would say that if we look back at some of the investments we've made that have paid off most handsomely, it's been a function of our capacity to know the team already and move with speed. Before I joined Bill Dietrich, I asked what many in the audience would ask him, how are decisions going to be made at the Dietrich Foundation? What's governance going to look like? And he said, Ed, investment committees in my mind should always be an odd number and 3 is too big. I was like, God, I love your style. I said, will you put that in writing? He said, yes. So I operate with the enormous luxury of not having an investment committee. And that allows us to move really with great speed compared to some other institutional LPs. So I think some of our best deals have really played out of that.
Great responsibility.
So you asked us about mistakes as well. And, the one that comes immediately to mind is one we did in the early days of the pandemic when we were still trying to figure out, how to work remotely. And in this case, it was a direct deal, but we didn't spend the time with the founders that we always would. We did lots of Zoom calls, but we found out too late after we had invested that basically they were telling us what they thought we wanted to hear. And I'm confident that if we had spent the time we normally do, you spend a few days together, you go for dinners, you can figure out when somebody's not telling you the truth. And, it was an expensive lesson, but after that, we didn't do any more without, COVID notwithstanding, without people who we knew were the real deal.
What are your thoughts on a sole GP versus GP consisting of several individuals?
So we have done a couple of solo capitalists, as they like to call themselves. And I don't think we'll make a portfolio of that, but we will do it where we feel there's something special. And it's where that individual has that high level of authenticity. And I think that's a word you hear among the founder community a lot, that they want to work with an individual, not necessarily a firm. So I do believe that there is a personal brand that some people can generate and as a result have highly differentiated and extraordinary access. But you have to be comfortable with all the baggage that goes with that. Not necessarily having a good sounding board, not to mention the key man. I mean, key man, that's all caps and neon. But there's also that rigor that goes with debating with partners that isn't always there. But we have done that and we'll probably continue to do that selectively.
So I agree that you like to back personal brands, and that can be very compelling. But I'm not comfortable investing in a solo GP. And it's not just the proverbial, what if they get hit by a truck? Of course that's there, but that's true in pretty much every one of our investments. It's more like, what if they want to go on vacation? What if they get sick for a week? You just, you don't have to have two equal partners. We have a number of investments where you have a very clear senior partner who's brought on board a junior, but still at a credible partner level. And I'll do that. But one person by themselves, and I think the collaboration, the debating, I think that's super important. And people can do that differently. They can find other advisors and stuff, but it's not the same. If you're not kind of living together, you don't have the same knowledge, and tends to be a bit too much of an echo chamber.
There's a lot of talk about climate funds, health tech funds, and so on. What is your view on funds which are specialists versus generalists?
Depends on the specialist and what they're doing. Generally, like what we are selling to our investors is a diversified portfolio. So, for example, we have some specialist funds in, say, cybersecurity. It's a specialized area. No problem with that. It's interesting because some things that used to be specialists become generalists. Like I remember a decade ago investing in mobility funds, for example. I think we're seeing the same thing today with AI, where today, yes, you can have an AI fund, but before too long, every company's AI. So I have no problem.
AI.
Like it's part of the flavor of assembling a portfolio. So you're going to have some generalists, especially later stage, but on the earlier stage, especially in certain kind of tougher disciplines, specialist funds are great.
A quick piece of advice to the GPs out there who, and I've heard pitches where they say, we're specialists. We really focus on healthcare, B2B, consumer tech, fintech. We really don't touch real estate. The fact of the matter is there's been an age-old debate about specialists versus generalists. Yes, you need a specialist to be able to discern the opportunity set effectively and with some speed, but you also want a little bit of room so you can toggle as market conditions make a sliver of it completely unattractive. So we debate that internally all the time, and to Rick's point, you have to look at the underlying strategy and the people involved, but we look at both.
When somebody tells me something like that, I kind of think, well, if you see a deal you like, you're going to fit it into one of those buckets anyway, so it doesn't really matter what you call it.
Yeah. As we run out of time, I want to thank you. It was very interesting and insightful. Thank you very much.
Thank you. It's been a real pleasure.